Hi, Gabriel Josiah here again. Welcome to another financial insight session. In this video, we are diving into the working capital turnover ratios. And this happened to be the last ratio in the series of our efficiency ratios. It's a vital measure of how effectively a company utilizes its working capital to generate revenue. This ratio reveals not just the efficiency of short-term asset management, but also the company's overall operational effectiveness. As aspiring accountants or chartered accountants in training or finance professionals, understanding this ratio is crucial for evaluating a company's liquidity and sales performance. Let's break down its policy, its formula, implications, and how it can influence your decision making in the business. Let's take a deep dive as I share my screen, which is our usual custom, to look at this metric or this ratio practically. Okay, I've gone mini. Working capital turnover ratio measures how efficiently a company uses its working capital to generate revenue. It shows how many times a company's net working capital is turned over in a period, indicating how well the company is utilizing its short-term assets and liabilities to support its sales operation. So we have working capital, where your current asset less your current liabilities is the funds or amount used to generate or support sales activities. The formula is clear on the screen. We have the net sales divided by the average working capital for the period, where your net sales is total revenue generated from sales, and the average working capital is current assets minus current liabilities averaged over the period. So let's use this example we've been using to buttress this very practically. So my screen is the same company, Sharubutu Nigeria PLC, and we're going to take our sales figure for the financial period 31st December 2020. So let's use our Excel. If you have your calculator, just follow me closely as I make these computations. It's a plus and minus, divide by, multiply thing your calculator can seamlessly do. So we have our formula as net revenue as the numerator and average working capital as the denominator. So we have currently the sales, which is our revenue. Let me bring it back here. And it's clear that our sales for the period is 1.2 billion naira. This is very important. So let's go get our average working capital for the period. Our average working capital for the period. So our working capital is a composition of our current assets and our current liabilities. So our current liabilities is deducted from our current assets. So as you can see from the SFP, you'll see that our total current asset for the beginning period is 800 million. That's January 2020. And for the ending period is 1,045,000 naira. So we pick both the beginning and the ending, so we could get the average. So our total current asset, picked it, and let's use it to calculate our net working capital ratio. So I'll take this or describe this as the beginning and have the same and describe this as the closing. Okay, so we have both our opening and closing current assets. So let's have the total and we'll call it total. Okay, so we could get the average current assets. Very simple. So we have this as our beginning and closing divided by 2. Average current asset is 922,500,000. So let me zoom out the screen a bit so we could see everything graphically. Now let's do our total current liabilities. So let's go pick that from this financial statements in the question. So our total current liabilities is a sum of 400 million at the beginning and 400 million in the end. So we take that, post it as 400 million. So we have the beginning and we have the closing. So opening to have, just drag it down, we have the closing. Very simple. So we have the total is as 800 million. So let's have the average current liabilities, which is the difference between 2 divided by 2. So we have the average current assets as 400 million naira. So let's have average working capital, which is expressed as our average total current assets less our average current liabilities. Very simple. And we have it as 522 million naira, as you can see on the screen. 522 million naira. So from our formula, you'll see that the working capital turnover ratio is the net sales divided by our average working capital. Let's go and calculate that very easily. So our net working capital ratio is our net sales revenue divided by our average working capital. We have this as 2.3 times. We have it 2.30 times. So our sales or our net sales covers our working capital 2.30 times. And this is good because it's a positive figure and a lot more than 1. It's about 2.30 times. Okay, so what does this mean? Let's go and describe or explain what it means. It indicates how efficiently the company is using its working capital to generate revenue. So the higher ratio, like we saw, or we just saw in this computation, means that the company is using its working capital efficiently to drive sales growth. The lower one, less than 1, suggests inefficient liabilities, which is critical. And the implication is that a high working capital turnover ratio implies that the company is generating more revenue with less working capital, indicating strong operational efficiency. So as you can see, 2.3 times shows it has doubled in the period its revenue, the little working capital that was provided. And this is commendable. However, if this ratio is too high, it may indicate that the company has very little working capital available, which could lead to liquidity risks, meaning the working capital could have been exhausted and there will not be enough funding in the short run to run the day-to-day activity of the business. It's a bit risky. So a low ratio could indicate poor working capital management or excessive investment in current assets relative to sales. So it's vice versa. Now, what is the cause and effect? The cause and effect of a high working capital turnover is that it shows efficient inventory management, quick collection of receivables, or tight control of payables. So the circle that has to do with inventory management, receivables management, and payables management is working effectively. And that's the cause of a high working capital turnover. And the effect shows or culminates in improved sales generation, strong liquidity, but has potential for liquidity risk if the working capital is too low. While conversely, a low working capital turnover is caused by poor management of inventory, slow receivable collection, over-reliance on current assets, and also slow payment of payables. These are the causes, and the effect is real. It's clear by reduced sales efficiency, cash flow challenges, and potential strain in short-term operations. This is critical. So in conclusion, the working capital turnover ratio is an essential measure of how well a company utilizes the short-term assets and liabilities of the company to support its sales activities. The higher ratio reflects efficient use of working capital, but can pose liquidity risk if the working capital is too high. So as chartered accountants or accountants in training, we need to be able to strike a balance, understanding this key ratio and mastering the skill. It's key to being able to balance this metric in our day-to-day operations. So balancing this ratio ensures the company is managing its resources effectively while maintaining sufficient liquidity to meet short-term obligations. This is very important. So we've explored the net working capital turnover ratio and its significance in evaluating how well a company leverages its short-term resources to drive sales. So to do a recap, a high ratio indicates efficient use of working capital, but it also comes, like we said, with potential liquidity risks if the capital is too or is stretched too thin. Conversely, a low ratio could signify inefficiencies that hinder sales performance. So striking the right balance, remember, in working capital management is key to sustaining operational success. All right, if you find this video helpful, which is the last in the series of our efficiency ratios, please like, share, and subscribe. And don't forget to hit the notification bell for more financial insights. We're moving into another type of ratio in the next class, and this has to do with long-term solvency and leverage ratios. Keep learning and refining your skills in this exciting world of accounting and accountancy. Until next time, bye for now.